In 2009, a man in Phoenix named David sold every single stock he owned. The market had just dropped 50%. His retirement account looked like a crime scene. He had watched $180,000 become $90,000 in about 18 months. And every morning the news told him it might get worse. So he sold. He locked in the loss, moved everything to cash, and waited for the world to stop ending. The world did not stop ending, at least not the way he expected. Instead, something quieter happened. The market started crawling back, then walking, then running. By 2013, it had fully recovered. By 2021, the S&P 500 was up over 600% from its 2009 low. David missed almost all of it. Not because he was stupid, not because he lacked information. He had a financial advisor. He had read the books. He knew the phrase, buy low, sell high. He knew about compound interest. He even knew somewhere in the back of his mind that markets had always recovered. He sold anyway. And here is the thing that should make you uncomfortable. Most people in David's position did the exact same thing, and most people in your position watching this video right now would probably do the same. That is not an insult. That is the most important financial truth almost nobody talks about honestly. Long-term investing does not fail because of bad math. It fails because of something far older than the stock market. We are living through one of the strangest moments in financial history. More people have access to investing than at any point in human civilization. There are apps that let you buy fractional shares of Amazon for $3. There are index funds with fees so low they barely exist. The information advantage that Wall Street had over ordinary people for decades has largely collapsed. You can read the same research reports, track the same data, watch the same earnings calls. And yet, the average retail investor still dramatically underperforms the market. Not by a little, by a lot. A study by the research firm Dalbar has been tracking this for decades. Their most recent findings show that over a 30-year period, the S&P 500 returned roughly 10% annually. The average equity fund investor over the same period returned closer to 4%. Same market, dramatically different results. The gap is not caused by fees, though fees matter. It is not caused by bad stock picks, though bad picks happen. The gap is caused almost entirely by behavior, by the decisions people make when the market does something uncomfortable, by selling when they should hold, by buying when they should wait, by doing something when doing nothing was the right answer. This is the central paradox of long-term investing. The strategy is simple. The execution is nearly impossible, and the reason it is nearly impossible has almost nothing to do with money. To understand why long-term investing feels the way it does, you need to understand something about how your brain was built. Not metaphorically, literally. The human brain spent roughly 200,000 years being calibrated by survival pressure. For almost all of that time, the correct response to danger was immediate. If something threatened you, you acted, you ran, you fought, you made a decision, and you made it fast. Waiting was not a strategy. Waiting got you eaten. The problem is that your brain cannot easily distinguish between a lion and the stock market crash. Both activate the same threat response system. Both produce the same hormonal cocktail of cortisol and adrenaline. Both trigger the same urgent command, do something, do it now, and stop the bleeding. Researchers call this loss aversion. The psychologists Daniel Kahneman and Amos Tversky quantified it in the 1970s and 1980s. Their finding was striking. Losing $100 feels roughly twice as painful as gaining $100 feels good. The pain of loss is not equal to the pleasure of gain. It is disproportionate, it is heavier, and it distorts every financial decision you make. Think about what that means in practice. When your portfolio drops 20%, you are not experiencing mild concern. Your brain is registering something closer to crisis. The feeling is real. The physical sensation of watching money disappear is measurably stressful. Cortisol levels rise, decision-making quality drops. Patience, which is the entire foundation of long-term investing, becomes one of the first casualties. And the market knows this. Not intentionally, markets are not sentient, but volatility functions in a very real way, like a stress test for human psychology. The question the market is always asking is, how much discomfort can you tolerate before you flinch? Most people flinch. And the cruelest part of this system is that the flinch almost always comes at exactly the wrong moment. Because the moments when markets feel most dangerous, when the headlines are loudest, when your gut is screaming at you to get out, are statistically the moments when being in the market matters most. JP Morgan has published research showing that if you missed just the 10 best trading days in the S&P 500 over a 20-year period, your returns were cut roughly in half. 10 days out of roughly 5,000. And those 10 days almost never happen during calm markets. They happen during chaos. They happen when everything feels like it is falling apart. They happen when every rational instinct you have is telling you to be anywhere but here. Your brain, the one that kept your ancestors alive for 200,000 years, is almost perfectly designed to miss those 10 days. Now let's talk about time, because time is where the real cruelty lives. Everyone has heard about compound interest. Einstein may or may not have called it the eighth wonder of the world. The quote is probably fake, but the math is real. Here's the version that actually matters. If you invest $10,000 at age 25 and never touch it, assuming an average annual return of 8%, you'll have roughly $217,000 by age 65. You invested $10,000. You ended up with $217,000. That's the miracle. Here's the catch. Virtually nothing happens for a very long time. At age 35, your $10,000 is worth about $21,000. At age 45, it's around $46,000. At age 55, it's around $100,000. You've been invested for 30 years and you haven't even hit $100,000 yet. Then, in the final 10 years, something remarkable occurs. The account jumps from $100,000 to $217,000. More than half the total growth happened in the last decade. Compound interest is not a steady escalator. It's a long, boring, flat road followed by a cliff that goes straight up. And the only way to experience the cliff is to survive the flat road. The flat road takes decades. This is a fundamental mismatch between how investing actually works and how human beings experience time. We are not naturally good at waiting for rewards that are 30 or 40 years away. Research in behavioral economics calls this hyperbolic discounting. We value near-term rewards far more heavily than distant ones, even when the math clearly favors patience. A bird in hand, two in the bush. The bush is 40 years away. And this is before you factor in the noise. During those 40 years, the market will crash multiple times. There will be at least several moments that genuinely look like the end of the financial world as we know it. There will be years when your account loses 30, 40, maybe even 50% of its value on paper. There will be newspaper front pages declaring that capitalism is broken, that this time is different, that the old rules no longer apply. Statistically, they will be wrong, but they will feel right. They will feel more right than any spreadsheet projection could ever. Because numbers are abstract. Fear is not. Here's where it gets slightly ironic. The same technology revolution that democratized investing, that gave everyone access to markets and data and research, also made the psychological challenge dramatically harder. In 1980, if you owned stocks, you might have checked their value once a month when your brokerage statement arrived in the mail. You experienced your portfolio as a slow, largely invisible process. Bad days happened, but you didn't watch them happen in real time. You didn't feel the tick-by-tick movement of your net worth on a screen in your pocket.
Today, you can watch your portfolio lose money by the second. You can open an app at 2 a.m. and see that your holdings are down 3% in after-hours trading because of something a Federal Reserve official said at a conference in Switzerland. You can read 47 different takes on what that statement means by breakfast. You can join a Reddit thread where 12,000 people are collectively panic spiraling about the implications. More information, more access, more transparency, and more opportunity to make exactly the wrong decision at exactly the wrong time. There's a concept in finance called the paradox of activity. The more actively you manage a long-term portfolio, the worse your outcomes tend to be. Not always, but on average, reliably across decades of data, activity kills returns. Fidelity famously conducted an internal analysis of their best-performing accounts. The study, which has become almost legendary in investing circles, found that the top-performing accounts belonged to people who had forgotten they had the accounts and to people who were dead.
Think about that for a moment. The most effective long-term investing strategy is one that requires you to do essentially nothing. And we have built a media and financial services ecosystem that makes doing nothing feel irresponsible, reckless, and borderline negligent. This is not accidental. The financial services industry does not make money when you do nothing. Fund managers make money when assets move. Brokerages historically made money on every trade. Financial media makes money on engagement, and nothing drives engagement like volatility and fear. CNBC does not run a segment titled, "Nothing happened today. Your long-term plan is fine. Go enjoy your weekend." That segment does not exist. It will never exist because it does not generate clicks or views or the particular emotional state that keeps people returning for more information. The architecture of financial media is built on urgency. Every market movement is significant. Every earnings report is a crisis or a triumph. Every Fed statement is a turning point. The language is always war language: crash, surge, collapse, soar, bloodbath, rally. And none of it, statistically, matters much to a 30-year investor. A 2020 paper published in the Journal of Finance found that professional financial media coverage was negatively correlated with long-term investment performance. Not neutral, negative. People who consumed more financial news made worse long-term investing decisions. You are not imagining it. The noise is not neutral information. In many cases, it is actively working against you. Let us step back for a moment and look at this whole system from altitude. You have a strategy, long-term index investing, that is supported by more rigorous evidence than almost any other approach to building wealth available to ordinary people. The logic is clean, the historical data is overwhelming. The math, given time, is extraordinary. And then you have human beings, who evolved for a world that no longer exists, who are surrounded by media infrastructure that profits from their anxiety, who are given real-time access to information that previous generations never had and which mostly makes things worse, who are asked to do for 30 or 40 years something that produces essentially no visible reward for the first half of that timeline. It is a remarkable mismatch. The investors who succeed at long-term investing, the ones who actually capture the returns that the strategy promises, are not necessarily smarter than the ones who fail. They are not more analytical. They do not have better information. In most documented cases, they have one specific trait in common. They are extraordinarily good at doing nothing. Not passively, not carelessly, deliberately, with full awareness that markets are falling, that pundits are panicking, that every signal in their environment is telling them to act. They choose inaction. They choose the flat road. They trust the cliff is coming. Warren Buffett, who has built his entire public persona on the apparent simplicity of this approach, once said that investing is simple, but not easy. He was not being modest. He was describing something structurally true about the gap between understanding a strategy and being able to execute it when the world is on fire. Most people can understand the math. Almost nobody is immune to the feeling. David, the man from Phoenix, eventually went back into the market. He did it slowly, cautiously, after he felt like things had stabilized.
By then, he had missed the fastest part of the recovery. He got back in around 2012, 3 years later, when prices had already risen significantly from the bottom he had sold at. He paid a higher price to re-enter than the price at which he had sold in panic. He knew this. He knew exactly what had happened. He could trace the math himself on a spreadsheet. It did not make him feel better, and it did not stop him from being anxious the next time the market got turbulent. Because knowing is not the same as being able to act on what you know. Not when the information lives in your prefrontal cortex and the decision gets made somewhere older and faster and considerably less rational. The financial industry will keep selling you products and strategies and tools and apps. The media will keep serving you urgency. Your own nervous system will keep telling you that staying still while something falls is dangerous. And somewhere, right now, someone is selling everything in a panic. Someone else is buying it. One of them is going to look back in 20 years and understand exactly what happened. The question worth sitting with is, what is it about that person that makes them different from you? And honestly, I am not sure the answer is as comforting as we would like it to be.